Stock markets get all the attention. It's FTSE 100 this, S&P 500 that. They are way cooler than bond markets. Why? Well, because stocks are about the future, awesome, exciting new products, and higher earnings and profits than the year before. Bond markets are about asking the more boring questions like, why do you need to borrow the money? How will you pay it back? And what can go wrong? But they are also the perfect complement to equities. They are the dependable twin, the one that keeps the other grounded and ensures you don't lose your shirt when markets go sour. So with the help of Invesco, Baillie Gifford, M&G and Rathbones, our group of our on-call experts, let's have a closer look at bond markets and why boring might be interesting. A bond is basically a loan. Just as you or I would go to the bank to get a loan to buy a house or maybe a car, companies and governments also need to borrow money sometimes. A company may want to buy new machines or even another business. A government might need more money for its health services or to build a new motorway. Only instead of going to a bank for a loan, they will ask investors to loan them the money instead. And, just like us, they can get different types of loans, or in investment terminology, they can issue different types of bonds. For example, I could get a simple loan of £5,000 to buy a car. That may be unsecured. I either pay it or a debt collector comes knocking at my door. Or I might borrow £200,000 to buy a house. This is likely to be secured against the house itself, so if I don't pay the mortgage, the bank gets my house. A bond can be secured or unsecured too, and all sorts of other things. To help explain this better, let's use a pyramid structure which represents a company. At the very bottom are senior secured bonds. These are least risky because if a company goes bust, anyone owning these bonds has first dibs on the money the company has left on its book to pay these bonds back. Say it was a bond from Tesco. It could be secured against a Tesco supermarket building. Then you get senior unsecured loans. Still lower risk, but there's no building to sell to pay it back should things go pear-shaped. John Gumpel, manager of the elite-rated Brooks Macdonald Defensive Capital Fund, explains why he prefers senior bonds.
We think it's very important to be in a senior debt position, and it's very important to, again, not to have short duration. So most of our assets have floating rate exposure, but they're senior and high quality.
And by senior, you mean when the company's lending, that you're at the front of the queue to be paid
Absolutely.
back, as opposed to...
Absolutely. We want to be first in line to be paid the money, and we don't want to be squeezed by anyone else, another lender, in advance of us.
Then you get junior or subordinated bonds. After the holders of senior bonds have been paid, holders of junior bonds are next in line for a payout. Next up are convertible bonds. These are quite cool, a bit like convertible cars. They're bonds that can be converted to equities or stocks. James Mahon, manager of the elite-rated SVS Church House 10X Absolute Return Strategies, explains more.
A convertible bond is an interest rate, so like a fixed interest security, but there is the option to convert from the fixed interest security into the underlying equity of the company that has issued the bond. So a company will borrow money and will get better terms to borrow that money by adding this option to convert into the underlying shares. From our point of view, it's very interesting, providing one can buy the bond at a respectable price. So we would treat the bond as any other fixed interest security. We would look at the credit of the issuer. Were they respectable? Were they likely to maintain their payments? In other words, and if that is acceptable, then we will consider whether or not the equity option on top is useful. And that risk profile is very interesting to the fund because the bond is low risk, but the equity option provides upside if the underlying equity rallies, but not the downside if the opposite happens. So very interesting, and certainly interesting to the fund. It's a market that has been rather limited in recent years because companies didn't need to issue convertible bonds because conventional bonds were so cheap to issue, and companies have been able to borrow very cheaply.
And then, at the top of the pyramid, are stocks. These are the most risky. If a company goes bust, its shares can fall from any level, £1 to £2, £100 to zero. Investors can lose all their money. This pyramid has been simplified. There are other types of bond in between. Hybrids that could still rely on gentlemen's agreements, for example. And don't get me started on bank bonds. They've got their whole own naming system. Tier 1, lower Tier 2, upper Tier 2. Ben Edwards, manager of the BlackRock Corporate Bond Fund, gives us a brief explanation.
Best example is banks, because not only do they have bonds that are of multiple maturities, they have bonds that have multiple currencies, but they also have bonds that have multiple subordination, ranging from a AAA rated covered bond backed by prime mortgages all the way down to junior subordinated debt, maybe closer to equity in terms of its absolute risk. They may also be issued out of different operating companies, subsidiaries within the bank. All of those bonds are going to have different interests to pay to clients to compensate them for the different risks that they're taking on. We've given an example to clients recently where over a 2-year period, the worst Barclays bond in sterling you could have owned lost you about 3%, and the best one made you about 15%. So a huge difference there, and actually what it means is it can make more of a difference which bond you buy than which company you lend to, certainly over the short term.
At the end of the day, the reason behind these different types of bonds and the pyramid we have shown is that institutions want money and investors want returns. The terms of these bonds, their structure, and whether they are senior or junior, are the bargains struck by the two parties, giving a level of risk and return that's acceptable to both. The comfort of a greater certainty of payment is balanced against the opportunity for a higher return. Senior bonds have the greatest protection from default, but offer lower interest. Junior bonds have a higher risk of capital loss, but offer more income to compensate. So a Tesco senior secured bond may pay 2% interest, but an investor will be more certain of being paid, while a Tesco convertible bond may pay 4% interest, but does so because it carries more risk. So how does this work in practice? Here are two examples. Elite-rated Gamstar Credit Opportunities, whose managers like buying the junior debt of companies they think are on a solid footing, so they think they're buying more risky bonds but getting a better interest. But they are fairly certain the company will not default. It's an investment style unique to them. Meanwhile, 24 Asset Management, the team behind the elite-rated 24 Dynamic Bond Fund and 24 Corporate Bond Fund, are experts in asset-backed securities, the bonds that have collateral behind them. To find out more about bonds and the funds that invest in them, please visit fundcalibre.com.